counter the coronavirus impact, let me bring to the show my next guest this evening, Alejandro Zambrano, Senior Market Analyst, ATFX. Good evening, Alejandro, and thank you so much for joining us.
Good evening. Thanks so much for having me again.
Alejandro, I want to start actually exactly with the Federal Reserve measures. How durable is the stimulus that has been put around? Can it become inflationary in the long run, in your opinion?
I mean, all of this, the whole inflation debate, we had that for so many years now. And yeah, eventually, at least according to the textbooks, and I remember when I was a student, like whatever money you would push into the system would eventually turn inflationary. But we haven't seen any of that. And I think it's because the way the European economy is set up and changes go really slowly. But I think as well, if we have huge inflation, it would be relatively easy for the central banks to quickly dial back any QE and maybe even raise interest rates if that would be the case. So I'm not really concerned about that right now, as many other people
are. What is your assessment of the Bank of England movement that we saw just a few hours ago? Actually, it was the second in a row. In less than 2 weeks, actually, Bank of England cut interest rates to 0.1% and ratcheted up its bond buying program. Right now, the program is up to £645 billion, up by £200 billion. Do you believe this is going to be enough to, how can I say, to prevent recession, considering also the pressure that the UK is certainly because of the EU talks?
So it's difficult right now to assess if that's going to be having a huge impact. But if you look at it from a global perspective, they're pumping so much money into the system. For example, Austria increased its emergency package. That was about 9.5% of their GDP. Portugal added also stimulus of about 4.3% of their GDP. And Greece added about a stimulus of about 2% of their GDP. And in the UK as well, they've done some really big changes as well. I don't remember exactly the numbers, but I think it was like something like 15% of GDP from fiscal stimulus. So I think all of this will actually help the economy to stabilize. And you're getting like mortgage holidays in the UK, for example. You get a lot of different helps. For example, I have my son, he goes to nursery, and yesterday we received an email that he can't come to the nursery, but we don't actually have to pay for the fee for this period now. So we are receiving some support. And I think all of this is gonna definitely smoothen things out. But the problem with it, and the reason why, for example, stock markets are not higher, is because it's not the root problem. The root problem is the spread of the virus, and we need to deal with that. And I have some ideas of what could stop that.
Well, I mean, if you like, you can share with us because it's going to be extremely interesting.
Yeah, so I think we just need to follow the path as they're doing in China, effectively, and also the path as they're doing in Italy. Like right now, you look at the numbers, and we're actually just talking about it before going on air, how they have 5,322 new cases. However, though, if you look at the growth rate, there's actually a growth rate of about 13%. And that's actually very good, because if you dial back some 25 days, if you go back and look at the average daily growth rate for the last 25 days, that average growth rate is about 24%. Now we're pretty much down at 13. And I can't show you the chart here because you can't see my screen, but you can clearly see how the daily growth rate is going lower and lower and lower. And in China, in the case of the markets, and when confidence came back to the markets, that was about 2.5 weeks after they had everything on lockdown, and the growth rate in China from pretty much the beginning of February slowed down significantly. From being close to 35%, it slowed down. I don't remember exactly how much it was, but closer to 20%, and then went slower and slower and slower. And right now, for example, the growth rate in China is pretty much non-existent. They had 34 new cases, which is nothing compared with the total amount of cases. So what's next then? Well, you have Italy doing some good steps, you got Spain doing some good steps, you got France doing some good steps. We have Germany, which is lagging, and we have the UK, which is lagging as well. But the UK is shutting down its schools from tomorrow, and maybe they were going to push more. But I think we need more sort of actions as we've seen in France. In the US, they pushed a little bit like that, but if you go on webcams on Times Square, you can still see people just doing their own thing, like if it was any normal day. So I think when the US realizes that they need to do something about this and they start to have things in lockdown, I think give it 2 weeks after that, and I think from there we can probably see a low in the markets and confidence come back.
Certainly, then it's going to be a very difficult moment also for Italy in terms of economic point of view, because after this major hunker down, we cannot expect good performance in the second year, no doubt about it. I was wondering something. Certainly, the actions that the central banks undertook were specifically to support the banking system. Can we expect, can we put aside a credit crunch as an option at this point, considering the liquidity that, of course, specifically the Fed is putting in the markets, or still there is a possibility of credit crunch specifically in the US, because this has been a major issue for the country?
So I think that you should never say that nothing can happen, right? But they are supporting with all these, for example, obviously dollar-related swaps and pumping money into the system. And I think they are committed. If you look at the comments of Steven Mnuchin, he is committed to supporting their economy. And they're looking at these growth rates of coronavirus cases. And we need to remember that President Trump is going to be up for an election by the end of this year. So he's going to stop this. I think he's going to stop it, because the growth rate in the US, I did some calculations earlier today, so it's growing with a daily rate of about 35% per day. So unless he orders his country to lockdown within the next 7 days, their number of cases is going to be higher than, it's going to be close, I think I calculated some about 26% or so, if the growth rate in the US continues as it has been lately. So I think they're going to put an end to that, and that's probably going to be what we need. But obviously, if they delay things, then yeah, it's gonna become an issue. But I have trust in the central banks. They're gonna sort this out. In worst case, they're just gonna give money to people, and then they're just gonna. I'm quite confident of that. Especially, think about it. President Trump, he wants to be a man of action. He wants to help people. He wants to get reelected. More importantly, I think he's gonna do whatever he has in his power. And we need to. And people look at it from the wrong way. They kind of forget that the stock markets discount things. So, for example, remember when we had the very, very bad number from China? Everybody thought that the Dow Jones was going to gap lower. You know, when the PMI was about 34 or 37, something like that. I think it was 2 weeks ago, and it was sort of the lowest number ever. Well, that day, the markets did not come down. They came down a few days later, and the reason for that was because things started to spiral out of control in Italy at that point. And also, like, Chinese stock markets have held up very well. So I think what's going to happen, like today, for example, we got initial jobless claims. That was out. But as you said before, stock markets are up a bit. So they're ignoring this because the market is already down so much. From its yearly high, the Dow is down with 27%, and at one point it was down with 33%. So the data needs to come in much worse to be able to cause people to sell. The question is this, though: when are they going to start buying? Again, I think that comes when the U.S. says we need to stay at home, and they're much more they put in some more restrictions, like they have, for example, in not necessarily like France, but maybe at least like UK. I think that could be the first step.
In terms of U.S. markets, if we have a look at all the three major averages, as you said, Dow is down more than 27%. So in your opinion, have we bottomed out at this point, or there is still place to go down?
Depends on what kind of investor you are. If you are like saving to your pensions, ETFs, if you have a 2-year investment horizon, I would buy now, and I would buy every month for whatever you want to save. That's what I would do. So for them, it's good to go now. And also, like, companies that you like maybe it's Apple or any other thing that you like that you wanted to buy before, I think that as well one can allocate and start buying now, because you never know exactly where the low is going to be. But if you buy a bit now, you buy a bit when you get your next paycheck, and your next paycheck, and then your next paycheck, then we should be fine. Because when the market declines more than 20%, it takes about 2 years for the market to recover. And right now, it's super, super scary. I remember the recession of 2008 and 2009 when the markets just tumbled. And I was young at the time, or younger than I am now. But I was new. But then afterwards, I read this article about this guy. He said, yeah, I bought Volvo trucks, so the truck maker. He said, I bought Volvo because I knew that in 2009, when the recession was there, of course, nobody wants to buy trucks. But give it a year or two, and people are going to be buying trucks. And that's the same thing here. I'm looking at companies like the owners of Gucci. Nobody is buying 500-pound shoes right now. But as soon as this is over, they're going to go back and buy those 500-pound shoes. And that share price, I think it was down, Care was down with about, 30 to 40% as well. So let me see here exactly. It's down with 38%. So I'm sure Gucci is going to come back, and all those luxury brands, for example, they're going to be bought. So for that sort of investor, I will be buying now and just keep on buying over the next few months. However, if you're like a CFD trader, short-term trader, leverage trader, then at least right now in the Dow Jones, the trend is bearish below the March 17th high, and that is the 21,351 level. Trade above it, and that would dent the downtrend, and that could be the beginning of a bigger push to the upside. So keep an eye on that March 17th high.
All right, that's extremely interesting. I'd like to get to the foreign exchange, because if you remember last time when we spoke, I was saying there isn't any volatility. Instead, situation right now is extremely interesting. Actually, if we have a look at the dollar index, it's set for biggest winning streak in 3 decades. So far at 102 mark, 1.73% higher. Euro dollar on the other side is 106, and sterling against the dollar 1.15. So extremely interesting developments over there. I want to start with the dollar index. What are the new levels that we can expect at this point from now on in the upcoming days, considering the fact that the coronavirus peak is going to, it's far in the US, the peak, and also in the UK.
Yeah, so the next levels then, you have the high from January 2017. That level is 103.8, or 103.8. So that will be your second or your next target, which this market is targeting. And at least for now, when you see the trend is so strong, you want to ride it and trade it to the upside, but eventually it will snap and you have a bigger correction. If you remember, the euro dollar went from its 2020 low all the way up to a new 2020 high, right? It raised about 1 year's of a bit more than I think in a year's trading gains or declines. And it's the same thing here. Everybody's just buying and buying and buying. But then eventually people are going to realize that this is madness, and they're going to sell off. But for now, I would keep an eye. So there's a low here from March the 19th. So that low, that's 175. Above that level, this short-term strong uptrend will continue, and we can hit something like 103.8. But take that out, and that's probably going to be the beginning of some profit taking.
What about the sterling against the dollar? We saw major depreciation of the sterling, specifically yesterday. What's the outlook over there, and what's the new target?
So right now I'm looking at my chart, and we're trading at 115.35. And I actually told, because I do a morning webinar every day with ATFX on their YouTube channel, and I told people to actually sell around 118 with stop loss orders above 121.35. So we hit that spot perfectly, and the market moved down. Actually, the actual level was 117.84. So we come down to a bit of support near last week's or this week's low. So one could book a bit of profit here, maybe 50% of that position. But if we take out this week's low, I think we're going to head down. And I think naturally maybe we'd be something like 114, and then 113, and then 112. But those are just psychological levels. because when I tried to go back in time and see what levels were relevant, there's not so many data points because we're dealing with levels that we haven't seen since 1985. So we're looking at almost 35-year lows here in the British pound. And the first sort of low from a historical point of view that is visible on the chart, that would be the low from the week of March 18 in 1985. And that low is 110.54. So that's the next horizontal support level on the chart. But on the way there, you have those psychological levels that you can work with. So if we take out this week's low, and that week's low is right now at 114.40, then I would push down my stop loss from 121.35, and I will probably just put it at 118.50, and then we'll see how far lower this goes. And I think what's happening here is that people are pricing in a hard Brexit, because you have Michel Barnier, he got positive for coronavirus.
Yes.
I mean, he's like the top dog, right? Who's going to lead the negotiations? Of course, there's other people involved, but Prime Minister Johnson is every day holding a press conference for us here in England, and I'm sure Macron and all the other leaders are doing the same thing. So their focus is right now not on the trade talk. And so what happens then by the end of the year? Well, if the UK goes out, they have no trade deal, maybe they will be trading at tariff levels with some countries. Well, if the currency started declined with some 10, let's see how much would it be down from this year's high. It's already down with some 12%. So say it goes down to the 1985 low, then actually let's just see from last year's low, then we're down with 3.5%. But if we go down to the year from the lows from 1985, then we would have lost about 12%. So then maybe it doesn't matter so much for the exporter that that we are trading now on maybe World Trade Organization tariff levels, because it's going to be cheaper for the buyer, the European buyer, to buy our products. The problem is, as soon as the people here want to go travel, everything is going to be more expensive. And because they import a lot of product, and particularly food, and also people coming from Europe, then inflation is probably going to creep up in the UK because of this slide.
So at this point, what are you trading in terms of foreign exchange?
I mean, if I would focus on something, I mean, what's a clear trend? You have clear trends in the British pound.
Yes.
So you can trade that one being bearish pretty much below 121.35. And if we do swing up to close to yesterday's high or today's high, I would look to sell. As well, you can focus a bit on the Aussie dollar, even though, you know, volatility is quite dramatic. But as long as you trade below today's high of 159.68, I think we can go down to this week's low, 155.09. And if you look at it from a really long-term perspective, I think the Aussie dollar, I mean, it has traded below the 2008 lows, and I think the Aussie dollar is ultimately heading towards the lows from 2001. So I think we're heading down to 0.47 over the next few months and years.
What about the Canadian dollar? Because in Canada, the situation is pretty particular. The wife of Justin Trudeau also is positive on coronavirus, for coronavirus. So the border of Canada and the U.S. is completely closed since yesterday. So do you expect any, how can I say, decline in terms of economic point of view, or not? Because this is just, of course, a shutdown of people passing the border, but not goods.
So I think, so the Canadian dollar is so closely linked with crude oil, right? And we clearly saw when crude oil weakens, the Canadian dollar weakens as well. So that is actually what's driving things here at the moment. But then, of course, you have the coronavirus situation. Now, I don't actually keep track on the number of cases in Canada, but if it is a situation that they have higher growth in the US, then that would be an issue. But by the looks of it, I don't think they are having a higher growth rate in virus cases than the US. And I haven't never experienced it or done so much analysis on it, but as far as I understand, and the healthcare system in Canada is much more stronger than the US one. So from that perspective, I do suspect that the Canadians are probably going to be able to cope with the virus better than the Americans. I just did a quick check here, right? So the growth rate of viruses is 8% today for Canada, whereas in the US, the growth rate is 18.46% today. So from sort of virus perspective, relative perspective, I think Canada is probably going to do better. However, one of the reasons, as far as I understand, why the dollar is gaining the way it is, and I didn't have time to verify all of this, but apparently some 40% of all loans in the world are in dollars.
Yes.
But the American economy is not made up of, they're not 40% of the world economy. It's far less, which would mean that the difference between the American size of their economy and the loans, that will be, for example, emerging market countries. So you have, for example, places like Turkey, where they won't necessarily lend you money in Turkish lira, rather you need to borrow in euros, so you need to borrow in dollars. And it's the same in places, for example, like South Africa. So the problem now, which I think is driving this, is that everybody's sort of in panic and they're seeing their countries crumble. So, for example, if you're in South Africa, right, and you're making money in South African rand, then you need to take that money and then you need to pay back in dollars.
Right.
Yeah, but what's happening now is that they don't want to have that risk. So it looks like everybody's sort of hedging their positions. And that is why we're having this bandwagon effect on the dollar.
All right. Thank you very much. Alejandro Zambrano, Senior Market Analyst, ATFX. Thank you for joining us. Have a great evening. And of course, take care.
Cheers. You too. Thank you. See you soon.
Well, we're heading for a very short commercial break, but stick around because Don Gramza is joining us for more market analysis.